Good morning, everyone. This is T3 Live Editor-in-Chief John Darcy here to bring you a morning call. We're going to make it nice and quick as we're heading into the open here on Friday. But the S&P futures are up slightly this morning. They're coming back in a little bit as we approach the open. We can go ahead and take a look at the chart. As you can see, there's been a downtrend in place since all this government shutdown stuff started. We're on day 4 of the actual shutdown. The market has been sort of indecisive. There hasn't been really any momentum to the downside for more than 1.5 days at a time. But we do continue to just sort of bleed lower. We've held the 50% Fibonacci retracement from this bounce to those new highs that came after Fed Day. So we continue to hold that 50% fib level. That'll be a key level for short-term composure. If we continue to hold that 50% fib retracement level, it could keep some semblance of bullish composure intact, but right now we're sort of hanging on by a thread. And the longer this government shutdown drags on, the closer we get to that debt ceiling deadline, October 17th, the more anxiety is going to grow. And the more fear is going to grow that something catastrophic could happen, which not raising the debt ceiling on October 17th would be catastrophic. It would really negatively impact the U.S.'s credit rating, and that could lead to a big down move in the market like we saw a couple of years ago. But in today's morning call, I'm going to go over the stocks that we talked about in last night's Off the Charts because I'm generous. It's obviously a premium newsletter, but I'm going to give you some updates on some recent setups that we've been listing on Off the Charts. The first one was Lululemon. Yesterday, Lulu had a really nice extension into the gap. It's one that we talked about, a really textbook bull flag here after it gapped down but impressively reclaimed that gap and more, and then put in a nice bull flag, it was a great looking pattern. We listed it on Monday, and then it extended higher yesterday into the gap. I think we could get a gap fill up here to the 82 area in Lululemon and see it reclaim its status as a market leader. JP Morgan, another one that's been a little bit weak but has bounced and then put in a bull flag after a recent bounce. It's not trading at highs, which I sort of like a little bit. It's sort of hard to chase stocks at highs right now, but some of these lower level type trades that are maybe playing a little bit of catch up, those are a little bit more attractive to me right now because there seems like there's a little bit more room. People aren't really scared to chase them the way they are with some stocks at highs right now, it feels like. So you look at the chart of JP Morgan, we had that igniting bar. Once the final news of that settlement with the Justice Department came out, $11 billion. Yeah, it's a big chunk of money, but when you look at how much money JP Morgan makes every year, it's really not that big of a deal. So finally getting that news out of the way was a positive, and it's been ranging. It's been a sort of a wide range bull flag here, but we have every time that it's tried to breach the lower end of that flag, it's rallied back above. And then yesterday when the market was weak, JP Morgan held in reasonably well. And I think if the market does find some footing and put in a 2-day bounce or something meaningful compared to the small bounces that we've gotten recently, I think you could see JP Morgan trade back, fill this gap up here, and get back at least to that $54 area as a first stop for JP Morgan. Sandvik is another one that we talked about. It's held up reasonably well since Wednesday's igniting bar. Yesterday, it did have some weakness, tested the 8-day moving average, but bounced off it, finished narrowly positive. When you get a big igniting bar like we saw on Wednesday, typically that leads to more upside. And if you can get some rest after that igniting bar, that's better because it can give you more calculated entry. Sometimes after they ignite, they don't wait and they continue higher. But I think this one, some rest would be healthy to give you a little bit more of a calculated entry. But I do think we could see the stock back up here near 64, which would be 52-week highs. And then on the flip side, there were several stocks yesterday that sort of flashed some caution signs. Obviously, high beta tech has been the place to be in the market for the past few months. You've seen rotation out of defensive type sectors after that taper talk started. The taper didn't end up happening, but you saw some rotation out of those sectors after the taper talk started, and tech has been the clear leader in the market. But yesterday you saw some big names in tech actually show some weakness and some signs to be cautious. Apple with a little bit of a red dog reversal after 3 days up. Traded barely up through the previous day's high and then engulfed it back down below. So that's a big sign of caution for Apple. It's back into the 8-day, tested the 21-day yesterday. So this is one that's going to need a little bit more time, I think, to break that downtrend from early August. Talk about Amazon, another similar type situation. Engulfed the previous day after a breakout failure at all-time highs. LinkedIn, similar situation. LinkedIn engulfed the previous day. Google engulfed the previous day, a little bit of a breakout failure above a pivot. The Amazon breakout failure was above highs, but there was a lot of breakout failures above some lower level pivots in tech. And then another setup that I really like, a new one that we put on the radar yesterday and Off the Charts, is Mastercard. Yeah, you look at it and you say, what do you mean Mastercard is in a descending channel? It's been weak. Yesterday it showed some weakness, but when a stock breaks out to highs, it's a macro strong stock. You look at this trend in Mastercard, I mean, that's absolutely incredible move that it's seen over the last several years. You love to see a descending channel to get a calculated entry. And you just draw your line, you draw your downtrend line here, and you don't enter the trade until it breaks that downtrend. You don't try to cheat. You don't try to get in at the bottom of this channel. You wait for an entry, and that's when you're going to get potential momentum, and then you have some room back up to highs. So I think this is one that if the market does firm up, I think Mastercard could follow suit, and I think it could give you a nice calculated entry if you just watch this descending channel. Those are just a few ideas. I think in general right now, the market is extremely choppy. It's a headline-driven tape. This is not the type of tape that traders enjoy. You've heard everyone around T3 talking about how they're limiting their exposure to the market right now, not taking big bets in either direction because we're not really reaching those extreme oversold levels that are attractive to buy, but we're also, there's nothing really telling you that there's just not an environment to make big bets in either direction is all I'm really trying to say. We could get more anxiety leading up to that October 17th debt ceiling deadline, and so I think in general, until that happens or until we get a resolution to that, I think it's best to keep exposure down. And if you do get some rest and maybe a little bit of a bounce, maybe you could be looking to short it if we don't get resolution to that. But I think right now, low gross, low net, like Scott's been talking about, low exposure to the market is the best approach right now. This has been John Darcy, T3 Live Editor-in-Chief here for the morning call. We'll see you back here for the recap.